$700 billion supercomputer just to map out the future of artificial intelligence, only to wake up and realize its entire survival depends on, like, a single 21-mile wide shipping lane in the Middle East. Welcome to Weekend Recap. I'm Daniel.
And I'm Mira.
So it is Sunday evening, July 12, 2026. And for you listening right now, the mission of this deep dive is to basically establish the macro baseline you're operating against as we enter what is, guaranteed to be a really volatile new week.
Yeah, we're taking a huge stack of weekend market logs, macro reports, and some incredibly tense geopolitical flashpoints to, extract the core narrative for you. We've essentially got this massive tug of war going on right now.
Right. A tug of war between a $700 billion AI infrastructure supercycle on one side and on the other, just a massive geopolitical energy shock.
Exactly. But before we get into the mechanics of all that, just a quick reminder that this show is for market context and discussion only. It is definitely not personal investment advice or recommendation to buy or sell anything.
Absolutely not. So, session one. How did the markets actually behave last week, and what does this tell us about the current baseline?
Well, looking at Monday, July 6th to Friday, July 10th, we saw a really volatile U-shaped swing. The S&P 500 dipped from Monday's close of 7,537 down to a Wednesday low of 7,482.
Right, which was a pretty severe midweek shakeout.
Yeah, it was. But then it rallied hard to finish Friday up at 7,575. And the Dow did the exact same thing, dropping over 700 points Monday to Wednesday before entirely recovering.
And fear tracked right along with that, right?
Completely. The VIX peaked at 1690 on Wednesday during the worst of it, but compressed all the way down to 15.03 by Friday's close.
But, equities only tell half the story there. The real tension, the invisible force acting on those stocks, is in fixed income and credit.
Oh, without a doubt. The 10-year Treasury yield climbed to 4.569%, and the 30-year reached 5.071%.
Wow, over 5.
Yeah, and when you have risk-free rate rising like that, it drags down investment-grade corporate bonds. So the LQD ETF actually fell from 108.67 down to 107.46.
And commodities were just an absolute roller coaster, too. Brent crude spiked 8.4% to a Wednesday high of $78.02 before cooling off to $75.97 on Friday.
Gold was equally volatile, plunging to an intraday low of $4,081 before rebounding to $4,128.
So we ended the week with a market leaning heavily on tech and energy. But I really have to challenge this Friday baseline. That equity rally feels deeply disconnected from the bond market.
How so?
Well, think of the tech sector as a rocket ship trying to reach escape velocity, right? Powered by AI earnings. And the 10-year Treasury yield is gravity. We know the discount rate acts as equity valuation gravity. So if a 10-year yield is pinning higher near 4.6%, gravity is incredibly strong. Are equity investors just blindly buying the dip and ignoring that?
They're essentially betting the rocket ship has enough fuel to just outrun the gravity. The resilience on Friday showed investors weren't pricing in systemic stress yet, but that narrow leadership leaves valuations incredibly vulnerable to an external shock.
Which brings us to the weekend. Because if we look at Friday's Watch Next logs, markets were focused on really mundane stuff, like the Baker Hughes U.S. oil rig count, and prepping for Monday's Fed Governor Bowman's speech, and some routine Treasury bill auctions.
Which feels like a completely different reality now. Session 2. What exactly happened over the weekend to shatter the June ceasefire, and how does this alter our macro context?
Yeah, shattered is the right word. So breaking this down chronologically, it started on Friday. U.S. officials issued strict demands to Iran, telling them to declare the Strait of Hormuz open or face military options to keep their nuclear sites inaccessible.
And the diplomatic breakdown was just instant. Iran's foreign minister immediately accused the U.S. Treasury Secretary of breaching paragraph 9 of the June ceasefire.
Right. And then on Saturday, July 11, things got kinetic.
Very kinetic. Iran's IRGC Navy fired on and halted a container ship, the GFS Galaxy. And then they formally declared the Strait of Hormuz closed to all maritime traffic.
Which is a massive escalation. So in direct retaliation for that closure, U.S. Central Command launched massive precision airstrikes. They hit roughly 140 Iranian military targets.
Yeah, missile bases, radar, naval assets, systematic targeting.
But then Sunday, July 12, Iran fired back We saw drone and missile strikes across the Gulf, Qatar, Kuwait, Oman, Jordan, the UAE. Now, I mean, it's really tempting to look at missiles flying and treat this like an unpredictable natural disaster, right? Like markets will just panic sell on Monday.
I actually have to push back on that framing. We really need to look at this geopolitical escalation as game theory bargaining leverage. I mean, Iran isn't just lashing out randomly.
You don't think so?
No, look at the targets. A drone directly hit a Kuwait oil company drilling platform, injuring a worker, and strikes hit logistics centers at the port of Duqm in Oman.
Which is fascinating because Oman and Qatar are frantically trying to mediate a two-lane safe shipping agreement right now.
Exactly. Why strike the mediators? Because it proves nowhere is safe. The port of Duqm is strategically located outside the Strait of Hormuz. By hitting it, they're showing they don't just control the choke point, they can degrade the alternative routes too. It's a calculated move to expand their leverage and threaten global physical supply.
Right, they are weaponizing the reliance on physical infrastructure to raise the stakes for the U.S. So let's pivot to the other side of the macro barbell. Can the $700 billion big tech AI capex supercycle basically outrun an oil shock?
The demand signals late last week were just wild. I mean, Thursday, SK Hynix launched a massive $26.5 billion ADR offering.
And it opened 14% higher on Friday, just because AI memory demand is apparently unchecked.
Yeah. Institutional money views AI physical infrastructure as a mandatory allocation right now, but there are cracks forming in that ecosystem too.
Huge cracks. On Friday, Apple filed a blockbuster trade secret theft lawsuit against OpenAI, and Meta had to halt its Muse image feature entirely after massive user privacy backlash.
That Apple lawsuit is critical. We're talking about proprietary chip architecture and server optimization. If the foundational players are suddenly locked in existential legal battles over physical designs, the efficiency of that $700 billion spend drops significantly.
It's a reminder that we're building the plane while flying it. And just to add some macro spice to the weekend, Japan is officially urging its massive GPIF pension fund to increase local investments.
This is a huge mechanical shift. The GPIF is the world's largest retirement pool. If Japan is urging them to repatriate capital, meaning sell U.S. assets and buy Japanese ones, that strengthens the yen, but it threatens to create a global liquidity vacuum.
Right. If the biggest buyer of sovereign debt brings its money home, yields everywhere else have to rise, which feeds right back into the gravity pulling on our equity rocket ship.
We also saw the sudden passing of U.S. Senator Lindsey Graham on Saturday, which just adds a layer of fiscal and defense spending uncertainty right as a regional conflict flares up.
So investors are walking into Monday caught between soaring AI capital intensity and a severe physical energy shock. Which means session 3. With a regional war on our hands and inflation hovering, what are the exact data points and events we need to watch in the coming week?
Well, looking strictly at the calendar, Monday, July 13, starts with the OPEC monthly oil market report.
But the real event is Iraqi Prime Minister Ali al-Zodi visiting Washington for planned U.S.-Iraq oil and gas MOUs.
That is critical for non-Hormuz riding. Then Tuesday, July 14th, is just a collision point. At 8:30 a.m. Eastern Time, we get the June U.S. CPI and core CPI.
And then at 10 a.m. Eastern Time, Fed Chair Kevin Warsh delivers his House testimony.
Right, but I actually question if the market is putting too much weight on Chair Warsh's testimony.
Really? Why?
Well, the Warsh Fed has intentionally reduced forward guidance in favor of really narrow data dependence. So that Tuesday CPI print might completely override whatever prepared remarks his team wrote on Friday.
That's a great point. If inflation is reaccelerating, a pre-written dovish script gets thrown out the window instantly.
Exactly. Then Wednesday, July 15, keeps the pressure on. 8:30 a.m. Eastern Time is the June PPI and core PPI. Warsh heads to the Senate at 10 a.m. Eastern Time, and the Bayes book drops at 2 p.m. Eastern Time.
And Thursday, July 16, brings June retail sales, initial jobless claims, and the Philadelphia Fed survey at 8:30 a.m. Eastern Time.
Wrapping up Friday, July 17, with industrial production and capacity utilization at 9:15 a.m. Eastern Time, followed by preliminary July Michigan consumer sentiment at 10 a.m. Eastern Time.
Which brings us to a Sunday night reality check for you, the listener. Because average investors are experiencing profound whiplash right now. Risk on basically means putting on a helmet before checking Monday's pre-market futures.
Yeah, it really does.
I mean, we've built a $700 billion supercomputing empire just to ask chatbots how to hedge against a regional energy war. If the midnight crude oil spike doesn't wake you up, Tuesday's CPI print and share wash certainly will. Happy Sunday night reset, and may your safe haven assets be as sturdy as big tech's belief in its own valuations.
We'd love to hear how you are positioning your own portfolios for Monday's open, so we share your thoughts in the